Okay, hello students. So in today's session, we are going to attempt the past paper question from March-June 2024, uploaded on the ACCA website. Okay, so the first question is GAMGEE company. Let's read it. GAMGEE company is a large listed company which has a diverse range of operations. Current information about GAMGEE is as follows. Current year operating profit is 177 million. Debt has 6% bank loan for 50 million. Equity has 800 million issued shares. Corporate tax rate is 20%. Current EPS is 0.15. Interest cover is 6.6 times. PE ratio is 8. Total gearing measured as debt over debt plus equity using market values is 32.3%. Growth in profits has declined in recent years, and GAMGEE's large institutional shareholders are insisting that the board of directors undertake an expansion plan. So scenario is that GAMGEE is a large listed company. It has a diverse range of operations. Current information is as follows: that current year operating profit is 177 million. Debt has 6% bank loan for 50 million. Number of issued shares are 800 million. That's not the dollar capital. It's 800 million issued shares, number of shares. Corporate tax rate is 20%. Current EPS 0.15. Interest cover 6.6 times and P ratio 8. Gearing measured as debt over debt plus equity using market values is 32.3%. Growth in profits has declined, and shareholders are insisting that the board undertake an expansion plan. Okay, expansion plan. The board of directors has developed a plan which involves a project requiring 360 million initial investment, earning an annual operating profit of 64.8 million. So your operating profit is 177 million. The expansion plan is that 360 million initial investment required, and this will earn an operating profit of 64.8 million. Expansion finance. GAMGEE does not have sufficient cash reserves to finance the project. Therefore, two financing options are: option 1, issue of 5% loan notes for 10 years expected to trade at nominal value. How much loan notes will be issued? You know that expansion plan requires 360 million initial investment. It does not have enough reserves. So the first option is that 360 million can be raised by 5% loan notes at nominal value. Second option, right issue at 25% discount to the current share price. So current share price, I don't have the current share price. I need to find it because I have the P ratio 8. It's market price per share upon EPS. So I have the EPS. So current share price, I can find it, and then right issues at 20% discount to the current share price. Whichever finance option is chosen, following are to be assumed. Finance will be raised and investment undertaken in time for the project to be operational for the start of next year. P ratio will remain unchanged. So whichever option you choose, debt or equity, assume the following: that the finance will be raised, investment undertaken in time for the project to be operational for start of next year. Project will be operational for the next year, and P ratio will be unchanged. Okay, so this is a very normal source of the finance scenario where you are given the current date of the company, and you are being told that this is the profit and this is the loan, and the company is planning to basically issue either right issue or the debt issue of 360 million, which will result in profit of 64.8 million. So this is how things are going to work. So requirement: to aid its decision regarding which finance option to select, the board of directors wishes to see the impact of each option on following three ratios. The board wishes to see the impact of each financing option on three ratios: interest cover, EPS, gearing. Requirement A1 is calculate the above three ratios for next year, assuming project is financed by loans. So you need to find the above three ratios for next year, assuming it's loan notes, and then above three ratios for next year, assuming project is financed by right issue. Okay, 8 marks. So let's start this. And firstly, let's assume option 1, project is financed by 5% loan notes issue. Okay, so we are assuming project is financed by 5% loan notes issue, and we need to find the three ratios for next year. Okay, so let's start it. Okay, now let's check the current scenario. Currently, your operating profit is PBIT, right? It's 177 million. This is current, okay? And currently your debt, that is called the 6% bank loan, right? That is also called the 6% bank loan. So it's 450 million. That means the current interest cost is gonna be 6% of 450 million. Okay. This is your PBIT. This is your interest cost. So this will create PBT. So what is your PBT? 150. Then you are going to pay tax 20%, 30. So your PAT is 120, right? And you have a number of ordinary shares. $800 million, right? So this is the current scenario that seems to me. And that's why you can check that the company has calculated its EPS as PAT 120, let preference dividend 0, number of shares 800 million. So it's coming as 0.15. This is the current scenario. Some people may argue that is not needed, but just to explain you in a better manner, many things are not required for the exam, but obviously I'm explaining you. So just to explain you in a better manner, I have done this thing that I have drawn the current scenario. That currently 177 million is the PBIT operating profit. Interest is 27 million. 450 million debt, 6%. Deducted, you get PBT. You pay tax 20%, you get PAT. Number of shares is 800 million, you get the EPS. So you are not required to find the current EPS because current EPS, current interest cover, everything is given. Even if you find the current interest cover 6.6 times as PBIT, 177 upon interest 27, you will get it. Okay. Now, assuming you need to calculate the three ratios, assuming project is financed by loan notes, assuming project is financed by 5% loan note, assuming project is financed by 5% loan notes. Let's see what will happen if you finance the project by 5% loan notes. Okay, assuming you finance the project by 5% loan note. Now, what will happen to PBIT? PBIT is the operating profit. You finance the project by 5% loan note, 360 million investment by loan note, and operating profit will be 64.8 million. That's PBIT, right? So if you finance it by loan note, 360 million investment would result in 64.8 million PBIT. So for next year, you're asked to find the ratios for next year. For the next year, your PBIT is going to be 177 plus 64.8, 241.8. Okay. Let's check what would be your interest cost. Your current debt is 450. You will pay 6% interest on that. Plus, how much more debt you are getting? 360 million. More debt, right? And you're going to pay 5% interest on that more. So your interest cost is going to be 45 million, right? Because 27 is already there. Okay. And you borrowed 360 million at 5%. So 18 million interest would be created more. So your interest cost would grow to 45 million. Are you getting this point? that if you see this data, 450 million into 6%, this is my current debt, 27 million interest cost. But if I take 5% loan notes, 360 million, my debt cost would also increase 316 to 0.05, 18 million. So interest would be 45. And now my PBT would be 196.8. I will pay tax. That is D6 196.8 into 20%. And after that, my PAT would be 157.44. Number of ordinary shares. Do you think if I raise the finance via debt, my number of shares would increase? No. Will still remain at 800 million. This is if I take the 5% loan note issue, my PBIT is going to rise by 64.8. My interest would rise 316 to 0.05, 45. And this is how my things are going to work, then tax, then PAT, then everything, right? Now, if I raise all these things via debt, I have made the P&L now. I need to find 3 ratios, interest cover, EPS above 3 ratios for next year if loan note issues. Okay. So currently, the 3 ratios are current EPS, PAT less preference dividend over number of ordinary shares, it's given 0.15. Current interest cover is given. That's 6.6 times PBIT upon interest. And current gearing is given. Debt over debt plus equity using market values, 32.3%. So I was not asked this. I was asked to find the 3 ratio for next year, assuming finance is raised via debt. So assuming finance is raised via debt, I have to calculate 3 ratios for next year. Let's find EPS. If I go for debt, for EPS, PAT is 157.44. So that's D8 minus preference dividend 0 divided by number of ordinary shares is D9. Okay, so this is the EPS. So number of ordinary shares has to be 800. Okay, 0.1968. Okay, interest cover, it's PBIT upon interest. So PBIT is D4. Our interest is 45. 5.3733. Okay. Gearing is debt over debt plus equity using market values. Okay. How to handle this? Let's see. Debt over debt plus equity using market values. So I need to find market value of debt and market value of equity, because debt over debt plus equity using market value. So I need to find the market value of debt and market value of equity. Okay, now if you try to find the market value of debt, so we currently had debt after loan note issue. The current debt was 450 million. Trading at 120 by 100, 130 by 100 was given. So I would have done that, but trading at 120 by 100, 130 by 100 is not given. So this is the market value of debt. Plus through equity option, so through that option, I have gained more debt of 360 million, right? So my market value of debt would be 450 existing, plus in this loan note option, I have taken more debt, 360. So it would be 810 million. Sir, why you are not doing that which you taught it in the class, 360 million trading at 120 by 100, 130 by 100, had it been given, I would have done that. But it's not something that is given here. 450 million, not given 120 by 100, 130 by 100, I won't do. 360 million, not given 140 by 100, 150 by 100, I won't do. So currently my debt was 450, but I raised more debt. So the market value of debt would be 810. Market value of equity is number of ordinary shares into current share price. Now, what is the current share price? Okay. I don't have the share price in the question, but I have the PE ratio. And the question is saying after this option, PE ratio is going to remain constant. That is what the question is saying, that after this thing, PE ratio will remain constant. Okay, so if the PE ratio is going to remain constant at 8, okay, it's market price per share upon earnings per share, right? So earning per share has been found after this option as 0.1968. Okay, so 0.1968 is the earning per share. Now apply the formula of P ratio, market price per share upon earning per share. P ratio is 8 after this option and EPS denominator is 0.1968. You can get the market price per share as 1.5744. Okay, and market value of equity is number of ordinary shares, that is 800 into current share price 1.5744. Okay, this makes it 1259.252. And now gearing debt over debt plus equity using market values. So debt is 810 upon debt plus equity. So 810, I can write it as D14, debt over debt plus equity using market values. 39%. Okay, so I have got all the three ratios for next year. I have got all the three ratios for next year. Assuming that company raised finance via debt, I had to find EPS, interest cover, gearing. Now, very easy. If I raise finance via debt, my PBIT is rising, interest is rising, PBT, tax, PAT, number of ordinary shares are remaining same. EPS for next year, very easy. PAT less preference divided over number of ordinary shares, interest cover, very easy. PBIT upon interest. For gearing debt over debt plus equity using market values, market value of debt, 450 million was the debt, 360 million more debt taken. Nothing like this mentioned trading at 110 by 100, 120 by 100. So no need to do that. 810 is the market value of debt. Market value of equity, number of shares into current share price. What is the current share price? P ratio is remaining constant and you have got the EPS after this option. So the current market price per share is 1.5744. 1.5744 into number of ordinary shares, you get the market value of equity. Okay, so this is done after the loan notes. You have got 4 marks. Please copy this. Then I will do the 3 ratios, assuming project is financed by equity. Okay, please copy this. Okay, now I have to calculate all three ratios, assuming it's raised by equity. It's raised by equity. Now, one thing that should be kept in mind that if the finance is raised via equity, again, 360 million has been raised via equity. Please pay attention. Again, 360 million has been raised via equity. So it has been invested. So for the next year, the PBIT is going to be 177 current, and you will gain 64.8 million more, 241.8. But do you think because of equity, your interest cost would increase? No. You have the same debt now, 450. Your debt is not increased. Your interest cost will remain same, 27. Okay. In that case, your PBT is going to be okay. Tax is going to be and your PAT is going to be 171.84. Okay. Okay, so seems very straightforward that the PBIT increased, interest didn't increase, PBT, tax, PAT. Now, one thing is important, number of ordinary shares. Okay, we all know that debt option, loan note option didn't increase shares, but equity option is going to increase shares. Okay, so let's see that the shares are increased. 800 million are the shares are increased. Now, pay attention. Equity will be at a 25% discount to the current share price. Equity is at 25% discount to the current share price. Okay. Now you don't have the current share price with you, but you know that currently your PE ratio, is 8. That's market price per share current upon EPS current. And your current EPS, it's given 0.15. Okay. So if P ratio is market price per share upon earning per share and current earning per share is given 0.15, you can simply multiply them to get the current market price per share as 1.2. Current market price per share is 1.2 and right issue is at 25% discount to the current share price, right? Issues at 25% discount to the current share price. So current share price is 1.2. Right issue is at 25% discount to the current share price, less 25%, it's at 0.9. And if it's at 0.9, then new number of shares. It's very important working, new number of shares. This can easily be calculated as 360 million is the finance raised, and they are issued at 0.9 per share. So new number of shares are 400. That means after the equity option, the shares are going to be 800 plus 400 million. 1200 million will be the shares. It's maybe a complicated working for some, so I'm explaining it again. Please pay attention. Okay. We all know that all these things till here were easy, but equity will increase the number of shares. How much? You are raising 360 million, right? You are raising 360 million. And it's saying that right issues at 25% discount to the current share price. Okay, so what is the current share price? Current PE ratio. You see, the current PE ratio. It's 8. So current PE ratio is current market price per share over current EPS. So you have the current EPS, you have the current P ratio, you can multiply it to get the current market price per share as 1.2. Now, current market price per share 1.2, right issue is that 25% discount to the current share price. That means right issue is at 0.9. So right issue is at 0.9, 360 million is the finance raised and at 0.9. So that means you are issuing 400 million new shares and this will make it 1200 million shares. Now you can easily get, very easily get the, what do you say, 3 ratios for equity option. EPS. EPS is PAT. That is F8 minus preference dividend 0 divided by number of ordinary shares are in F9, 0.1432. Interest cover is PBIT over interest. PBIT of this option is F4 over interest is 27. You get interest cover. And gearing, debt over debt plus equity using market values. In this option, the market value of debt is going to remain same, 450. Plus 360, no, you haven't raised debt. Market value of equity is number of shares into current share price. This was the loan note option. Now let's see the equity option. Let's see the equity option, that how do you get the market value of equity in equity option? Pay attention. Again, the P ratio is going to remain same. So it's 8. EPS after equity option. After equity option, you have got the EPS as 0.1432, right? So after equity option, 0.1432 is the EPS. P ratio is 8, market price per share upon EPS. So EPS is now 0.1432. You can get the market price per share after equity option, market price per share upon EPS. You have the EPS 0.1432. After equity option, you have the P ratio. You can get it as 8 into 0.1432, 1.1456. And the market value of equity now will be number of ordinary shares 1200 into 1.1456. This is the market value of equity now. And you get the gearing as debt over debt plus equity using market value. So debt is F14 over debt plus equity, F14 plus F15, 24.66%, approximately 25%. So you have got all three ratios using equity option. Okay, so this is worth 8 marks working. Some people may find the equity working a bit tricky. That's why I am telling you in advance, don't worry about it. Okay, it's a very straightforward thing that after equity, your PBIT is rising by 64.8, interest is not rising, PBT, tax 20%, PAT, number of ordinary shares have increased by how much? Working required, that current P ratio is 8, current EPS is 0.15, you get current market price per share, and then it's a 25% discount, 0.9. So that means you have issued new shares 360 million upon 0.9, 400 million, number of shares rising to 1200. Okay, then you get EPS, you get interest cover, gearing, debt over debt plus equity using market values. Market value of F debt is 450. Equity, number of shares into current share price. So after the equity and debt ratio, what is the number of shares into current share price? So P ratio is constant, EPS has been found, so you get the new market price per share into number of shares, you get the new market value of equity. Okay, please note this. Now, after this 8 marks working, it's a 3 marks working using calculations from 1 and 2, briefly comment on the results, recommend which source of finance board of directors should choose. So brief comment on the results, recommendation which should choose. So it's a general commentary that as we can see that loan note option is increasing EPS but is resulting in fall in interest cover and rise in gearing, meaning it is increasing financial risk. On the other hand, equity option is resulting in fall in EPS. See, 0.15 was the EPS, it is resulting in fall in EPS, but is reducing gearing and increasing interest cover, means financial risk is falling. So comparatively, equity option may seem slightly better, but some other information and ratios may be helpful to reach a proper conclusion on which source is better. Okay, so you always have to be diplomatic in this, right? Even if you read the examiner answer, it's just a brief comment on both the results, 1 mark, and which should be opted. We can just say that this seems better, but obviously other information may help reaching a better conclusion. So your first task was to briefly comment on the results. So I have commented that the loan note option is increasing EPS, decreasing interest cover, and increasing gearing. That means financial risk is rising. This is my comment on result for 1 mark. Comment on the results for 1 more mark. Equity option is increasing interest cover. Equity option is reducing gearing. That means reduction in financial risk, but it is resulting in fall in EPS. Again, comment on the results 1 mark. Which one should be chosen? So comparatively, equity option seems better, but more ratios are needed for a better conclusion. That's it. Okay, you can copy this. Okay, now uh, this is a bonus requirement of 5 marks. Discuss the problems associated with high levels of financial giving. Okay, so in my topic of sources of finance, I have made a complete heading, dangers of high gearing. I can also mention the question which we did in the regular classes. The question is Arvin Company. In that also this requirement came that what are the dangers of high gearing. This has been taught to you in the classes. You just have to memorize it and write it. And these 5 marks are, trust me, free. Like I taught you, I'm not writing the complete answer here, just reminding you the points that I taught you. High level of gearing leads to liquidity crisis. And the firm may not be able to pay off liabilities as they fall due. Remember? So the first point, high level of gearing leads to liquidity crisis. Firm may not be able to pay off liabilities as they fall due. This is not the proper point for 1 mark. That is written in the source of finance topic, which I taught to you. But just for a reminder, short point that it leads to liquidity crisis, firm may not be able to pay off liabilities as they fall due. High level of gearings leads to huge interest payments. High gearing means huge interest payments, leading to fall in profits and fall in dividends. Okay. One more point. High level of gearing makes it difficult to obtain further funding from bank. Okay, this was taught to you. Another point. High level of gearing makes it difficult to obtain credit from suppliers. Okay. Similarly, high level of gearing increases the financial risk of the company. There are many more points. High level of gearing leads to high KE, high WACC, because remember, the ordinary shareholders start demanding more KE, that risk has increased, and more KE means more WACC. So all these 5 points have been taught to you in sources of finance Arvind company question. You just need to memorize and write free 5 marks. Okay, please copy this. Okay, in a recent board meeting, the use of Islamic finance was mentioned as being another possible finance source as the nature of the project and all of GAMGEE's activities are eligible under Islamic finance. The board wishes to consider use of Islamic finance, but a condition the board has agreed is that any Islamic finance arrangement should be similar to traditional debt with no profit sharing or management involvement from the investor Islamic Bank. So board has agreed that any Islamic arrangement should be similar to debt with no profit sharing. No profit sharing. Okay. Discuss two sources of finance that Islamic finance that could satisfy GAMGEE's need for the project, taking into account the board's condition. Now, what is the board condition? Any Islamic finance arrangement should be similar to traditional debt with no profit sharing. Okay. So you need to discuss two Islamic sources of finance that could satisfy GAMGEE's need for the project, taking into account board's condition. Now, I have taught you 5 sources of Islamic finance. Remember the name? Muraba, right? Ijara, Mudarba, Musharka, Sukuk. In normal cases, you can write any 2 Islamic sources, Muraba, Mudarba, Ijara, Sukuk, Musharka. But here, you are not asked to discuss 2 sources of Islamic finance. You are asked 2 sources of Islamic finance that could satisfy the needs, taking into account board's condition. What is the condition? There is no profit sharing. So in that case, you cannot write Musharka or Mudarba here, right? Because in Mudarba and Musharka, there is profit sharing, right? In Mudarba, what happens? One party invests capital, other invests time, okay? Profit in agreed ratio, profit sharing, losses as per participation. In Musharka, pure partnership, both invest cash, both invest time and profit share. So if you write Mudarba, Musharka here, you won't gain any marks. So you can write 2 sources. They can be Muraba. You can define Muraba. You can write Ijara. You can write Sukuk. So explain any of these 2 for 2 marks. The definitions are in the handouts and you gain the answer. But you need to be really careful in answering what is asked, because many people say that 2 Islamic sources of finance are asked and the teacher taught us 5. We can write any 2 of that. You are right. Had the question stopped here, discuss 2 sources of finance that could satisfy GAMGEE's need, I would have written any 2 and moved on. Okay. But if it's asked taking into account board's condition, then what is the board's condition? Okay, so these things do lose marks, so you need to be careful that had the requirement stopped here, I would have written any 2. But since it's asking taking into account board's condition, and board's condition is that no profit sharing. So no profit sharing means you cannot write Mudarba and Musharka because in both of them there is profit sharing. Okay, so this question is now over. We have completed all the 20 marks. Okay. Okay, so now the next question for this Mar-Jun 2024 attempt, it's from Investment Appraisal Elan Company. A very easy question, but trust me, when this question came in the exam, many students complained it was a very difficult question. Let's see what was the difficulty in this. This scenario relates to 3 requirements. Elan Company is a company appraising an investment project to purchase and operate a hotel. Hotel will offer basic accommodation, including its own restaurant, mainly for the business traveler market. Hotel will be operated for a 4-year period and sold at the end of year 4. Okay. So hotel will be operated for a 4-year period, then sold at the end of year 4. Suitable property has been located costing 5.5 million. Will require new fittings, which are expected to cost an additional 1.5 million. So suitable property has been located costing 5.5 million. Fittings are also required at 1.5 million. So you can take 2 investments, 5.5 and 1.5, or you can take the combined investment 7 million. It is expected once the property is purchased, fitting can be installed quickly so that new hotel will be ready for business almost immediately. Hotel will have 50 rooms and open for 365 days. There are 50 rooms and will be open for all 365 days. Okay. 50 rooms are in the hotel, 365 days in the year. Forecast assumptions are year 1, the occupancy will be 50%. Only 50% rooms will be occupied out of 50. Okay. Year 2, 60% rooms will be occupied out of 50. Year 3, 75% rooms will be occupied. And year 4, 90% rooms will be occupied. Daily room rate will be 85 for the first year. Room rate is 85 for the first year, increased by 6% per year afterwards. Restaurant revenue will be equivalent to 35% of the accommodation revenue. Now, you need to understand this thing very carefully that when a person goes and stays in the hotel, there are two earnings for the hotel. One is the daily room rate. You stay in the hotel, give them the room rate. And some people eat in the restaurant downstairs as well. So restaurant revenue is 35% of the accommodation revenue. Not all people eat downstairs. That's why the restaurant revenue is only 35%. Variable costs are 20% of revenue. Incremental fixed costs are 433,000 in the first year, increased by 4% per year. Elan pays tax at 20% per year. Taxes paid in the same year to which is related. Tax at 20% per year. Taxes paid in the same year to which it relates. Purchase of property is not eligible for tax relief. So purchase of property is not eligible for that capital allowances, tax savings. Fittings will be eligible for capital allowance tax allowable depreciation at 25% per year on reducing balance. So note this thing that property costs 5.5 million and fittings cost 1.5 million. Property is not being allowable for that capital allowances. Fittings are allowable, 25% capital allowances, the TAD. Working capital equal to 5% of revenue will be required at the start of each year. Working capital will be released at the end of year 4. Expected sale value of property at the end of year 4 is expected to be 7.5 million after tax, and fixtures will be sold for 100,000. So fixtures cost 100,000 and property will be sold for 7.5 million. Property is not allowable for capital allowances. Okay. Real after-tax cost of capital is 4.8%, general inflation 5%. Elan has never operated a hotel before, which has made the estimation of above assumptions difficult. Also, inflation has been volatile in the country in which Elan is undertaking the project. Okay. So I think it's a very straightforward case that per 4-year life, hotel property 5.5 million, additional fixtures and fittings 1.5 million, 50 rooms, 365 days, occupancy is given, room rate 85 will increase by 6% per year, restaurant revenue 35% of the accommodation revenue, variable cost 20%, incremental fixed cost 433 increased by 4%, tax rate 20%, paid in same year, purchase of property not eligible for tax relief, and fittings will be eligible at 25%, working capital 5% of revenue. It will be released at the end of year 4, and sale value of property 7.5 million after tax, fixtures 100,000. Okay. Real after tax cost of capital 4.8, general inflation rate 5%, and it has never operated a hotel. Saying nominal terms approach, calculate the NPV and comment on its financial acceptability. So we all know that for NPV, we follow a general format in which the first thing is the capital allowance schedule. Okay. So for capital allowance schedule, we need 5 things: the investment, scrap value, life, tax rate, capital allowance method. We all have these things. So let's start the capital allowance schedule. Year, capital allowance 25% reducing balance, and tax savings at whatever the tax rate, 20%. Okay. Let's start the capital allowance schedule. 4-year life, 1, 2, 3, 4. Capital allowance is not available on the property, only on the fittings. So fittings are 1.5 million. Okay. So 1.5 million means 1,500,000. So I will take it in thousands, 1,500 into 0.25. Okay. 375. Then net book value 1,500 minus 375 into 0.25. Then 1,500 cost minus this B4, B5 net book value, and then 0.25. Okay. Last year working, you all know. First find the net book value, 1,500 minus B4, B5, B6. Okay. We don't apply the complete 25%. This is the net book value left. Okay. If you want, I can show you the working separately as well. That this is the net book value left at the start of year 4. 1,500 minus all accumulated depreciation. And the scrap value is 100,000, right? So whatever the leftover allowance is called balancing allowance or balancing charge, 532.813, that will be fully charged to the last year. Okay. And tax saving is at 20% same year. So B4 steric 0.2, and I can drag it to make a capital allowance schedule. Okay, so this is the first step, capital allowance schedule, which I have to follow. And in every question, the capital allowance schedule is must. What happens is that this is the last column. All things coming in this last column, it will be treated as an inflow when I will be making the capital allowance schedule. Okay, so it's year capital allowance tax savings. So 3 columns I have made. In the first column, you know that here comes 1, 2, 3, 4. Capital allowance not on the property, only on the fittings. It's 1500 into 25%, then net book value into 25%, then net book value into 25%. At the start of year 4, whatever net book value was left, deduct scrap value, leftover amount, and then 20% tax savings. Once we are done with this, we go towards NPV and we try to find NPV. And in NPV, you all know there is a format of NPV having a 4-year life. So 1, 2, 3, 4. So firstly, the investment comes. There are 2 investments. I'm sorry, the 0 also comes. So investment, there are 2 investments. One is 5,500 and one investment is 1,500. You can combine to get both as well. Then comes revenue, rooms revenue. Okay. Now room revenue has to be incorporated by you. And I think for that, I will be needing some workings as well. Okay, for the room revenue, I will be needing some workings as well. Let's shift this thing here. I have to create some space here. That's why I have shifted them here. Okay, now room revenue, I will show it in workings and I will show them in working 1 so that you properly understand and the examiner also properly understands. Okay. Now, pay attention. It's a very easy task. I don't know why students found that difficult or complained about them in the exam. You see, there are 50 rooms and hotel is open 365 days in there. That means the total rooms we are going to have is 50 rooms every year. And there are 365 days in there. That means annually you have these number of rooms, 18250, right? Because you have 50 rooms and there are 365 days in the year. So in year 1, 50 rooms into 365 days, total number of rooms. Year 2, 50 rooms, 365 days. In year 2 as well, total rooms. Year 3, 50 rooms, 365 days, total rooms. And what is the room rate? Okay. Room rate is 85 daily for the first year. And it's increasing by 6% per year afterwards. So B11 is increasing by 6%. Okay, every year. So normally, room rate into number of rooms gives you revenue. So in normal case, room rate into rooms gives you the total annual revenue, but here total revenue will be slightly different. 85 is the room rate. Pay attention. B11 into total number of rooms, B10. This gives you total revenue, but you won't get the revenue for all rooms in year one. Why? Because the occupancy in year one is going to be 50%. Okay. That means only half rooms will be payable, half rooms won't be payable. This gives you total revenue 775,625, right? And since I am working in thousands, I have to divide it by 1,000 as well, so that I get the revenue as 775.625. Okay, getting this point? To convert in thousands, I divide by 1,000. But understand the concept of room revenue. It's 85 room rate. Total rooms are 18250, but they are not paying me full. Only 50% occupancy means half rooms will be occupied. So half rooms will be paid 0.5. To convert it into thousands, this. Year 2. Room rate 90.1 C11. Total rooms C10. But they won't pay full. How much occupancy? 60% only. So you will be only paid for 60% rooms divided by 1,000. 986. Year 3. D11. Room rate. Total rooms D10. But in year 3, only the occupancy is 75%, so 0.75. Okay. Divide by 1,000 to convert it into 1,000. And in year 4, E11 room rate into total rooms E10. This can give total revenue, but occupancy is 90%, so only 90% paid. Okay. And this is the total revenue, which you need to copy and paste in year 1, 2, 3, and 4. So total revenue is B12, C12, D12, E12. Okay. This is the room revenue. I have given a comprehensive working of this room revenues. If you have any questions, you can refer to this working as well. Once room revenue is done, everything else is easy. I will work around and show you that everything else is easy. But trust me, capital on schedule was simple thing, not on property, only on fittings. Room rate inflated by 6% into rooms, 50 rooms every year, 365 days, but occupancy gets multiplied, you get the room revenue. Okay, please copy, then I will continue further. Okay, so I hope the revenue system is clear to you. Room rate multiplied by number of rooms every year, but the occupancy is playing a role. Now, after room revenue, there is another revenue that is restaurant revenue. Okay, restaurant revenue is very easy. 35% of accommodation revenue. Accommodation means rooms. So restaurant revenue is 35% of room revenue. So I will just take the revenue as 35% of accommodation revenue, that is L4. Okay. And we can drag it. Okay. You can also make one row for total revenue. You can do this. Like, for example, this is the room revenue, this is the restaurant revenue. I can take the total revenue and make one row, or I can just keep them separate. It won't make any difference, right? So if you want to create one row of total revenue, you can take the restaurant revenue here, 35% of the, what do you say, room revenue, B12. And you can drag this. And once you do this, you can take the total revenue. We will delete this. And we will take them as the sum of B12 plus B13, right? And we can drag this. Okay. Okay. So I have given you both options. It doesn't matter what you are doing. You can take both options, either put restaurant revenue, accommodation revenue different in NPV table, or combine them. Okay. After the revenue, we have to deduct cost, variable cost, 20% of the total revenue. See what's written here, variable cost, 20% of total revenue. So variable cost, I will write here 20% of total revenue. It's a deduction. So 20% of total revenue, that is in L5. Total revenue is in, yeah, L5. L4, sorry. Yes. This is the variable cost every year. Then after revenue, variable cost, incremental fixed cost, 433,000 in the first year. So fixed cost is 433 in the first year. And what is happening with that? It's increasing by 4% per year after years. So L6, steric 4%, and I drag it. Okay. Now you all know, is there any further cost? No. So revenue less variable cost less fixed cost. This will give me a figure called taxable profit. So it's the sum of L4 to L6. Okay. On that taxable profit, we will pay tax 20%. In the same year, negative 20% of the taxable profit. Then there is working capital investment and working capital recovery. Then there is scrap value. Then there is tax savings from capital allowance, so that I get the net cash flow. Okay, this is how things are gonna work. So Tax savings from capital allowances I can copy paste. 75, 56.25, 42.1875, and 106.56. Okay. Scrap value. There are two things that are being scrapped. Sale value of property 7.5 million, 7,500, and fixtures 100,000. So I can write separately and I can write combined 7,600. The last thing is working capital. Okay, working capital investment and working capital recovery. What about the working capital? 5% of revenue at the start of each year. So at the start of each year means at the start of year one. So working capital, 5% of revenue at the start of each year. So 5% of revenue means 5% of year one total revenue, L4. This is the working capital required, 5% of revenue each year. So in year one, year two, year three, year four, 5% of total revenue. So this is the working capital, 5% of total revenue each year. So 52 in year one. Then 5% of revenue, 13315%. Okay. But you know that when working capital is 5% of revenue at the start of each year. So at the start of year one means 5% of revenue, 50.2.35 we will invest in year zero. Negative B15. Okay. Start of year one means year zero. Start of year two, 5% of revenue, 66.6 required, but already it's present. So you will put the difference of C15 minus B15. Okay. Then at the start of year three means end of year two, 5% of revenue, 88.23 required, but you have already invested some deducted. So we are required with D15. You already put 14.24 and already put 52.35. Okay. And at the start of year four, 5% of revenue, 2244, 112 required. You've already put, this is required, but you have already put 21.64, 14.24, and 52.35. Okay. This is all working capital, 5% of revenue at the start of each year. So we put it in previous year, and whatever has been invested, we will recover it. So we have invested 52.35, 14.24, 21.64, 24. We add them all. This makes it 112.239. It will be recovered in last year. Okay. And that's it. We net them all to get net cash flows. This is the figure of net cash flows. They need to be multiplied with discount factor, but the discount factor, you must use nominal because you have calculated nominal NPV, or either you can use the NPV function. Nominal discount factor, I don't think was given in the question. It was saying real 4.8 and general rate of inflation 5%. So real cost of capital 4.8% and general rate of inflation was 5%. So if you apply 1 plus n is equals to 1 plus r, 1 plus I, the Fisher effect formula, so 1 plus n is equals to 1 plus r, 1 plus I, the Fisher effect formula will make it equivalent to nominal rate 10%. So either you can apply the NPV function or you can use the discount factor, present value, and NPVs. Both are going to yield same answer. Okay. So some people may prefer writing discount factor 10%, present value, and NPV. And if we apply the NPV function, we all know we have taught you this equals to NPV, bracket open, discount rate, that is 10%, comma, NCF from first year to last year. So L13 to O13, bracket close, plus NCF of the 0 year, that is K13. Okay. So this is the NPV, 368. And even if you do separately, you will still read the same answer. Okay. So this is the complete solution of NPV. You can copy, and if you have any queries, you can ask. Okay. Okay, so I hope this NPV working was clear to you. Capital allowance schedule was a very normal thing. It was normally on that investment of fittings only. Then two investments, then revenue, room rate multiplied by the total number of rooms, that was 15 to 365 into occupancy. Restaurant revenue, 35%. I got total revenue, then variable cost, fixed cost, taxable profit, tax, working capital, scrap value, everything was same. And I got the NPV. So 12 marks are done. Let's move towards the remaining four parts so that it results in an end. So explain how the approach to the NPV in part A would change if real approach had been used. Further calculations are not required. Okay, so how approach to NPV would change if real approach had been used. I will be writing the pointers and then explaining you the full answer. You have to draft on your own. You can also read the examiner answer. So how NPV appraisal would change if real approach had been used. If real approach had been used, the cash flows which have been inflated wouldn't have been inflated, and they would have been taken without the effect of inflation, right? If real approach had been used, the cash flows which have been inflated, like you inflated revenue, okay, you inflated fixed cost, they wouldn't have been inflated. They would have been taken without the effect on inflation. Similarly, the discount factor would also not have been inflated and kept at the real level of 4.8%. However, when NPV would have been found using real method, the final NPV would come out same as what we found in nominal. Okay, so this is just point. You can add, elaborate further. You know, the difference between nominal and real is that the final answer remains same. But if you would have used a real one, how approach to NPV would change if real terms approach had been used. The final answer won't change. However, the approach would have changed, that I wouldn't have inflated the cash flows which I had inflated. I would have left them what they are. I would not have inflated the discount rate and haven't applied the Fisher effect. I would have left it where is it. And then the final discounting result would have shown that the NPV remains same. Okay, so it didn't ask for calculations. These pointers are worth enough for 3 marks. You can just elaborate them a bit to get 4 marks. Okay. Okay. Now, the third part, explain how simulation analysis could be used by Elan in its appraisal of the hotel project and the expected benefits of using simulation. So how simulation can be used and benefits of simulation. Okay, so you know from the studies that simulation is a technique to deal with risk and uncertainty like sensitivity analysis, probability analysis. But simulation is a spreadsheet-based technique which uses range of outcomes. No calculation is tested. We just need to demonstrate how simulation can be used. Okay, so simulation has some steps. Step 1, okay, identify all major variables of the project. Okay, find possible values of each variable and associated probabilities of each variable. Step 2, input all these values in a computer. Step 3, computer will perform simulation, okay, which is random number generation. Simulation means random number generation. And find NPV possibilities of all outcomes. There are so many outcomes, so many probabilities. Random number generation will calculate many NPV possibilities, maybe in thousands of NPVs or even millions of NPVs. Okay, because there are so many outcomes, so many probabilities, so many variables, every variable changing, simulation performs randomly millions of NPVs. And step 4, it will guide and select the most likelihood NPV. Okay, so this is all about simulation. That it says how simulation could be used by Elan. Simulation is of 4 steps. You can basically memorize them. That simulation firstly identifies all major variables of the project, like selling price, variable cost, many possibilities of them, many probabilities of them. All these values are input in a computer spreadsheet model. Then simulation is performed, which means every possible outcome, every possible NPV, maybe millions and thousands of NPVs are calculated, and then most likelihood NPV is generated. This is how simulation can be used. Benefits of using simulation, you can write 2 benefits of simulation that is studied in the book reading classes as well. Okay, so it helps in decision making. Okay, it helps in calculating many NPVs much quickly. You can write these 2 benefits. So overall, simulation is a memorization thing. Part B, 4 marks theory, was very easy, and part A, the 12 marks NPV, was also easy. So hope this question is clear to you. You can copy this, and both these questions are complete for Mar-Jun 2024. Thank you.